All right, thanks for joining me today on my channel. Today we are going to be checking into a dividend stock in Canada, Canadian dividend stock. And what I want to ask first is, are dividend stocks in the oil industry too risky? With the war going on in Ukraine, if Trump comes in and ends it all, will Putin then flood the market with his oil? And Trump's America First program, is that going to somehow change our oil industry and how oil goes back and forth across the borders with the United States? So the stock I'm looking at is Pembina Pipelines. If you're looking at the oil industry, Pembina Pipeline may be one of the stocks in the oil industry you might want to consider if you're looking for something that may be able to handle some of those changes as they kind of happen in the industry. So as far as dividend stocks go, it's had 2 decades of a reliable dividend. The dividend is supported by steady cash flow, which is supported by contracts, which the company has. Historically, the dividend is between 6 and 7%. Currently, that dividend has dipped down to 4.79%. This might have something to do with the 20% increase in the stock price over the last year, though. The payout ratio for Pembina Pipelines is between 70 and 80%. Now, to have a good payout ratio, you probably want to be below 60%. But in this case, with this type of company, in that range is manageable, but there could be some risks that come along with it. The payout ratio is also higher than some of the peers, so there might be other companies that you may want to look into depending on what it is you're wanting to get out of a dividend stock in the oil industry. In recent years, they've had a dividend increase of 3 to 5%, which is not great, but you can see that they are dedicated to trying increasing that dividend and maintaining a high dividend for their shareholders. So their revenue base is highly attached to these contracts they have, as opposed to being part of the fluctuation of the commodity price. So when the commodity price changes, it doesn't necessarily change the contracts that they have for the services they provide. They've also had some investment into the clean energy. So clean energy, low carbon, they've invested into these areas. So as the industry starts to transition into more of the EV and other types of fuel sources, Pembina Pipeline has started that investment and may be a potential growth area in the future. So now, is it a growth or a yield stock? Now, the thing is, with the price increasing, the dividend yield, of course, right now maybe isn't as attractive as it was when it was 6 to 7%. But is the company going to rebound? Is it going to increase its dividend? How is that going to work out? And if they continue to keep reaping the rewards, I guess, of these contracts and they keep increasing their dividends, that may mean that the price now may be better than it might be in the future, which means as they increase their dividends, you will get more and more dividends. So today might not be such a bad time to buy, but if there is any complications that come up and the dividend is not increased, or they don't get the growth out of the stock, you're not going to get that potential payout that you're looking for. On the other side, the investments they're doing into the clean energy and low carbon may have that potential to give you the growth you're looking for, may have potential for more contracts and a growth that way. So of course that will keep their cash flow high, allowing them to keep increasing their dividend, which should actually be a positive going forward. And even though there's a change in American politics, I don't know that electric cars are going away, seeing as Trump and Elon Musk seem to have a little bit of a bond there. So that may show that there is still opportunity for that EV market to grow in the States, even though Trump is saying that he's going to focus more on maybe the oil industry. So the way I see it is, this is a high yield stock. And maybe at this current point, it has dipped down, so it's not maybe as attractive that way. But going forward, I think it's going to be a high yield stock. And I also believe that this has potential for growth, but maybe a long term. Now, would I buy it today? Probably not. I think there's other options out there that might be better. I need to shop around a bit, or if the price drops, this might be a good time to jump in if there's a little bit of a dip or some potential of the dividend increasing at a higher rate. Now, if these things do happen, of course, then it goes back up to being more attractive. For myself, it's kind of borderline. I do like the company, and I believe it's still paying out on a monthly dividend basis. So if you're looking for a monthly turnover, that's also a positive as well. The PE ratio is between 15 and 18, showing that it's relatively affordable, but not necessarily good nor bad. So that's kind of showing you that it's okay. A PB ratio of close to 2, which is normal for a stock of this type based on its infrastructure needs and so on and so forth, and in this industry. So yeah, relatively normal. Debt to equity is between 1.2 and 1.5, so it's moderate to high, but is manageable. Return on equity is 10 to 12%, which, well, this is a positive indicator. And of course, free cash flow is a positive for this company. So the real red flags here are debt to equity is high. Therefore, interest increasing is a risk to this company. Recently, Canada has been dropping the interest rate, so maybe they have bypassed any more risk on the interest rate levels. If that interest rate can keep dropping, may help them to expand and invest more into future infrastructure. The other risk is there's limited dividend growth, and if they hit a point where they don't have the cash flow or they need to step up on the infrastructure to get more growth, that dividend may not grow. And for anybody who's wanting to see consistent growth in the dividend, that may be a risk going forward, depending on how they end up managing things. And of course, probably the biggest red flag is the industry itself going to be stable going forward? Now, with EVs coming in, that is something that has already kind of shaken up, the cars and what kind of forward motion the world wants to go with EVs as opposed to having fossil fuel vehicles. And is that something that's going to continue to shift the industry over to renewable energy? And is Pembina going to be able to make that transition, or are they going to be able to manage, where they're at right now and where they need to go? So the volatility is definitely there going forward. And then of course, the risk of Putin and the war in Ukraine, we don't really know what's going to happen with that. With Trump coming in, says he's going to end it right away, and is Putin going to be flooding the market with his oil to try and get cash back, to try and get contracts and so on and so forth, so that he can somehow control the recovery of his country? So is that going to affect the oil industry everywhere else? All right, so my conclusion is I like Pembina because it does have that history of doing a solid dividend. It is a company that has paid out a fairly significant dividend, and it looks like they have that idea of going forward with that. So for me, it is something I definitely keep an eye on. Right now, it's kind of not really a number one pick, but it's something that I am going to be watching for. If there's a dip or an increase in the dividend payout, I'm going to be jumping back into this stock. I do like it, and it is definitely one to keep an eye on because of the contracts and less reliance on fluctuation of oil prices. So it's definitely a thumbs up as far as interest, but at this point it's kind of a hold off and wait. With that being said, I am not an advisor, so please see an advisor if you're needing advice on getting stocks for your portfolio, or definitely do your own research to see if this stock is the right stock for you, and at the time that you're buying it, it's hopefully going to be a discounted price where you might be able to jump in and have better luck with what that dividend payout is. All right, now I also use WealthSimple, so I just want to share with you that I use that because it's easy to use. I don't pay fees, so definitely check into WealthSimple. I have a link below. If you sign up using my code, we both get the same, reward for it. And anybody who's new, it's easy to use and you don't pay fees. I like it, so that's why I'm recommending it. It's not a sponsor, so you can definitely look into it. There's no cost to it. All right, with that being said, thanks for joining me. We'll see you next time. Have a great day.